of the usual basic analysis, we'll be using some analogy, using some imagery from the Netflix series Squid Game. So, okay, wait. All right, so first off, a disclaimer, all imagery from the series is just being used for educational and illustrative purposes only. So no copyright infringement is intended. Okay, so personally, I think we're heading for a really good year for the stock market. So at this point, there really is no shortage of good companies to buy. So the market's always moving. There's always stocks that are moving within a range. So that always gives us trading opportunities. So the real question is, when is the best time to buy or sell? So you know what to buy, you don't know when to buy or sell. So, and what tools can you use to make these decisions? To be honest with you, there's no right or wrong answer. So the trading strategy depends on the person's risk profile, and different people tend to have different styles of trading. So in this webinar, we will discuss 3 main trading strategies and the technical use that you need for each one. Okay, so first off, we have the swing trader or the range trader. You will see here that I put in something like a video game style statistics for power, endurance, and agility. So by power, I'm referring to the financial capacity of the person, the amount of the trading amount that the person uses. For endurance, that's the holding period. So for this kind of trader, usually you trade small amounts, you hold on for short periods of time, and agility is how quickly the investor enters and exits the market. So you have 5 stars for agility. That means it's relatively quick in and out. So as I said, the swing trader usually trades relatively small amounts, quick in and out, opportunistic trades. So they usually buy at the immediate support and sell immediate resistance. And the key consideration here is price action. So swing traders look for stocks that have a defined range, so you know where the support is and the resistance is. So the tools that are commonly used by swing traders is trend lines, the relative strength index or RSI, and occasionally some of them use Bollinger Bands. Okay, so here's a chart of BDO. So for this webinar, I will be using only one example. In this case, I'm using BDO because it will illustrate all the trading strategies in one chart. So here we have the indicators that I mentioned. We have the RSI at the bottom. So for those of you who are not familiar with RSI, it is a momentum oscillator. So basically, it measures the speed of price movement. So the steeper the climb of the price, the higher would be your RSI. So the RSI ranges between 0 and 100, although commonly the common range is 30 to 70. So when you say the RSI is 30, that usually means that the price is oversold already, meaning that it has fallen by a big amount in a relatively small amount of time. And then when you have an RSI of 70, that usually means that the stock is overbought, meaning that it has risen a significant amount already. And then you have there, I drew on the chart some trend lines. So for the support and the resistances. And then you have the Bollinger Bands. Again, a refresher for those of you who haven't done the basic technical analysis. The Bollinger Band consists of three lines or curves. The center one, the red one, is a 20-day moving average. And then the 2 blue curves at the upper band and the lower band, that's the 2 standard deviations from the moving average. So basically, this measures the This is a measure of volatility. This gives you an estimate of how far the stock can go up or down away from its moving average, from its 20-day moving average. It's pretty useful, and as you can see from the charts, you know, hindsight is 2020. So looking back at the past now, we can see that the Bollinger Band was fairly accurate in predicting where the price would go. So these lines act as a kind of a dynamic support and resistance. Okay, so this is a sample entry exit strategy of a range trader. So if you guys identify as a range trader, if the qualities I described before resonates with you, you should be paying attention to this slide. Okay, here, pay attention to the left side of the chart where the box is. So you would see the first entry price would be 87.70. So the trigger here would be the convergence of trend support and or the Bollinger MA. So you have the trend support here, the orange line, and you can see it converges with the red curve in the middle of the Bollinger Band. So that would be your trigger for the buying. And then normally a range trader would go out, would sell when it touches the upper band. In this case, that's 90.80. And at the same time, that also coincided with the 70 RSI, or the overbought value. And then so you would see there where a range trader would enter and exit. And then you have another entry point at 90.10 when it went back to the support. And then another exit price at 97.10, again at the top of the Bollinger Band. And then when it went back down to the middle of the band, to the 20-day MA, that was at 92.10. The thing with the Bollinger Band is when you're trading at the upper envelope, that means you've entered an uptrend. So your support would be the red line, the 20-day MA, and then the resistance would be the blue line at the top, the upper band. So that's how you range trade using the Bollinger Band. And then after you enter at 92.10, the hypothetical range trader enters at 92.10. The next exit point would be at 99. And then if you move further to the right of the chart, you would see that you entered a new trend, a new range. So it was fairly easy at the first time. The first time it went above 101, it touched that price, went up, and then touched that price again. At that point, it also coincided with a lower band of the Bollinger. So that's 101. That would be another entry point, and then exit at the 108.9 level. This one, because you went below the middle of the band, that would imply a downtrend. So your resistance now would be the red line in the middle, and the blue band at the bottom would be your support. So that's why a usual range trader would exit at 108.9 instead of riding it out all the way up to, I think that's 110. So again, when it touched 101, that's another entry point, and then you can exit. By this time, you would have established this downward sloping resistance here at the top. So that would have been established, and you would be able to spot that 112.50 as your exit point. Again, moving further to the right, you would see that BDO entered the narrower trading range. The gains here are maybe around 5% gross. So you would still be net of commissions and all the fees. But as I said before, the range trader usually exits in and out, regardless of, even if it's just a small gain. The strategy here really is you spot ranges. For example, you have the range of BDO. You enter BDO, you sell it, and then you look for another opportunity elsewhere. So you don't concentrate in one stock. So because you have a relatively small amount of money that you're moving around, the best thing would be to squeeze out whatever gains you can from the market from multiple sources. So that's how range trading works. So in this case, in the narrower trading range, by this time, it was easy to establish the resistance at 106 because that's at first, that's the middle of the Bollinger Band. And eventually it's established after it was touched twice. So your 101 would still be your support. And then 106 is the exit point. So at first, that's your moving average for the Bollinger Band. And then it was established as the resistance. So that's your second exit point after your second entry. And then at this point, it went back down to 101. You would notice there was maybe a month of no activity because it wasn't touching the support. It was staying above the MA. But when it dropped back to 101, which was a support that was tested maybe 1, 2, 3, 4, 5 times before. So you have a fair idea that it's going to be a strong support. That would be another entry point. Some traders would have been shaken out by this big drop maybe 3 days after the buying. But if you weren't shaken out, you would have exited again at 106, at which point you might be regretting because it went back up again. But, you know, gain is gain. And then next, you enter another phase here with an upward trending support and resistance. This big drop right here, the first one at 103, that would have been triggered by a bullish divergence on the RSI. So for those of you who are not familiar with the RSI, when the price marks a lower low, but the RSI does not mark a lower low, that's what you call a bullish divergence. That means that the second drop in the price didn't have the same momentum as the first drop. So that means that it's due for a reversal. So this divergence here, you can match it up with the RSI at the bottom. So that would have triggered the buying at 103. And then at 108.50, that would be this one at the 20-day MA. So again, you would have missed out on that small part up there, but that's fine. That's 103. That's 108 minus 108.50 minus 103. That's still a gain. So once you go above that middle band, when it touched the middle band again at 108, that would have been another entry point. And then again at 116.10, that's when it finally touched the upper band of the Bollinger. That would have been another exit. So next would be the next range phase to the far right of your chart. So that's where we are right now. So we currently have a range between 127.20 and 133.50. So that would have been your entry and exit points. So you would notice with the range trader, when the price is moving in a steep climb or a steep drop, range traders tend to stay away because the thing with range trading is you have a established range, so you know where to enter and exit. So when you don't have an established range and you're a range trader, it would be best to stay away and maybe look for other opportunities elsewhere. Okay, so I hope that was clear. And then now we move to the next kind of trader. We have the trend trader or the trend rider. So this guy has fairly average stats across the board. They trade relatively mid-sized amounts. They go where the price action is and holds for as long as the trend holds. So that's why the endurance is a bit longer than the range trader. And then the agility is also lower because they usually don't exit so quickly. So these guys basically usually buy on breakout and then they add to the position. If ever it doesn't reach their target price yet and the price goes down a bit, they are willing to add to the position on subsequent breakouts and support tests. And then they tend to sell on weakness. They don't try to sell at the very top, but when the trend shows signs of weakening, they would sell. So the key consideration here is trade volume. Whereas the range trader would buy any stock as long as it has a range, even if there's not a lot of trade volume. The trend trader would not trade something that doesn't have significant volume. So the tools they usually use are the short-term moving averages, maybe 10 or 20 days. The moving average conversion and divergence, or what you call the MACD. And then some of them would use Fibonacci retracements and extensions. So this is the same chart of BDO with different indicators. So you have the moving average. For those of you who are not familiar, it's a indicator that takes the average of the past n number of days. So in this case, this is the 10-day moving average. So it takes the average of the past 10 days and it smooths out the line. So you don't get distracted by the up and down, and you have a general idea of the range of the trend. And then at the bottom, you have the MACD. So the blue line is what you call the MACD line. This is the difference between the 12-day and 26-day exponential moving average, which is a moving average that puts an emphasis on more recent data. You don't have to go all technical about it. I'm just trying to define it for you. And then the red line is the 9-day EMA, or exponential moving average. So the way you use the MACD, the histogram at the back, the bar chart, that's the difference between the signal line, which is the blue line, and the 9-day EMA, which is the red line. So if you have a higher bar chart, that means there's a bigger difference between the two. So that's also a measure of momentum. It's also a momentum oscillator, similar to the RSI, although this one, instead of taking price as the data for calculating, it uses the moving average. And then you have the Fibonacci retracement. This is particularly useful for when you're looking for a price level where the price would correct. And the extension part on the upper here, the upper side, this one is the extension part. So this is a calculation of how much it can move up or above the previous high. So this is using the Fibonacci ratio. So we don't need to go all technical about it, why we're using Fibonacci. But this basically calculates which is the 61.8% rise from the last high, and then the 1.61, and then you have the correction levels of 0.50. So those are the Fibonacci numbers. So here, the first buy would be when the price moved above the MA. So right here on the very left at 87.50. When the price moved above the moving average, that means it's reverting from downtrend or sideways. It's moving to an uptrend phase. So that's the beginning of your uptrend, which would trigger a buying from the trend trader. And it also coincided with the MACD signal line, the blue line, crossing the red line. So that's a buy signal on the MACD. And also you would see that the histogram at the back, the bar chart, starts to turn positive. So that's indication of momentum. So those two indicators together would give you a buy signal at 87.50. So as I said, the trend trader doesn't try to sell at the peak. So he would have sold at, the hypothetical trader would have sold at 92 when the price started to move below the moving average. So the fear here would be that the price trend would reverse. So the trader would usually choose to exit before it goes down. So that's why you have a selling at 92. But a few days later, the price moved above the MA again. So that would trigger another buying. And the MACD also crossed over again. So the trader would have bought at 92 again. I know it doesn't make sense. You just sold at 92, but you bought at 92 again. But that's what the indicators tell you. And sometimes when you're trading using technicals, you really have to be disciplined and you have to follow your indicators. In this case, you can see that the buy at 92 was a good call. And you would have sold at the Fibonacci extension at 110. Usually, a normal trend trader wouldn't have sold because the MACD is still going strong at that point. But it would have been sort of an overshoot if it goes above 110 because that's a really steep climb already. So that's one of the examples of when a trend trader would have sold even if the price isn't going down yet. So that would have been a good call because you could have bought back at 105. It went down to 105. That's back at the moving average. And then sold again at 112 when the MACD crossed over, when the MACD line crossed below the red line. So that's how you use a combination of Fibonacci, MA, and MACD. And then you would notice that this is the range phase after the selling at 112. The trend trader would have stayed away at that point because that was a fairly narrow range and only range traders would even bother with that. So the next entry point would have been when the price crossed above the MA again, coupled with the crossover in the MACD right here at the beginning of June. I don't know if you can see my mouse, but I'm trying to point at it. So that's your next buy signal. And then the next sell would have been when the price started to move below the MA at 113.20, coupled with a crossover again on the MACD. So that would have been a good call because it went down after that. So the next buying would be here at 106. Wait, where was that? Okay, the triangle doesn't exactly go to where 106 was, but that's when the MACD here at the bottom crossed over back above the red line. So that's the 106 buying. It also coincided with the moving average here. So the next selling, oh no, there's no selling after that. The trend would have been going strong, but you would have spotted a correction back to the moving average here at 112.70. Again, coupled with a crossover on MACD. And the next exit point would have been when the price started to drop below the MA here at 129.70. Again, you're not selling at the peak, but you're selling at a decent gain from your last two buying at 106 and 112.70. So the reason why there was no selling after 106, there wasn't really a sell signal at any point. So instead, you got a buy signal and then another buy signal. So as I said before, trend traders are willing to accumulate as long as the trend holds. So the reason why they would have sold at 129.70, at that point, the trend doesn't seem to be holding. Okay, so that's the trend trading example using a combination of MA, MACD, and some Fibonacci. So the next trader would be the position trader. This is your wealthy tito, your wealthy uncle who has a lot of money to spare. They trade relatively mid-sized to large amounts. Their style is to spot undervalued and oversold stocks. So they tend to accumulate at low price levels and they sell at a predetermined price target, which is usually far from their buying. Either the long-term resistance, the most recent high, or the fundamental fair value estimate. So the key consideration for them would be long-term fundamentals. Position traders would not buy stocks that don't have good fundamentals. The previous two, the trend trader and the range trader, don't particularly care about fundamentals. They don't look at PE. Usually, I'm speaking generally. They don't tend to look at the PE or whatever. As long as there's price action, they're there. So the position trader usually relies on long-term moving averages, maybe 50 or 100-day moving average, and again, the RSI. So this is the same chart of BDO. And this time I used the overlay for 50-day MA, the 50-day moving average, and then the RSI at the bottom. So this would have been the trading activity of a position trader. So the first one would be here, there. At 89, when the price started moving above the moving average. And then, sorry, okay. So when the price moves above the MA and the RSI is still below 50, that means it's not overbought yet. So you are showing a reversal of trend without an overbought signal. So that means it's still good. Ideally, it would be at 30 or with a divergence, but in here with the first entry point, there's none of those. And then the position trader would have added when it corrected at 88.90. And then he would have sold at 110, similar to the trend trader. So that's when the RSI reached above 70 here. And then you have the buyback again at 100 here. And then at 101. This was a established support at that point. So that's why the position trader would have bought. And the second buying at 101 also coincided with a bullish divergence on the RSI. You would notice that the position trader didn't sell at all during this period. Actually, he added at 98.50 when there was a big drop, and the RSI touched 30, which is the oversold value. And then he would have most likely sold at 118 when the RSI reached 70. So you would notice here, they don't buy in one tranche. They would accumulate at good prices. And then they wouldn't sell unless there's been a significant gain or unless there's a definitive sell signal on the RSI or it reached a previous high. So I think at 110, that was the previous high from a year ago. Okay, so after selling at 118 and the price dropped below the MA, when the price dropped below the MA, you saw the bullish divergence again in RSI. We mentioned this before in the range trading part. So that would have triggered the buying at 102 and then another buying at 110 when the price started moving above the moving average. And he probably would have sold at 113 when the price started to reach its peak and an RSI above 70. So that's how a position trader would have traded using a longer term moving average and RSI. So I hope that was clear for you guys. And for those of you who've seen the series, I know I used the three characters and most of you know who won. I'm not saying that the character I used for that kind of trading is the winner, because as I said, as I would like to say in my final words, there's no one size fits all winning strategy. There are winning trades, but there's no winning strategy that, you know, there are a lot of people who teach technical analysis who would claim to teach you the winning strategy for every single time. But you have to learn to adapt to how the market's moving and also to your own personality, because if you're an impatient person, I don't think you would do well as a position trader. You would be a better range trader or trend trader. And if you don't have a lot of time to monitor your investments, your stocks, you would probably be a better position trader than a range trader. So again, you have to adapt to how the market is moving and also how you as an investor tend to trade. And another reminder before we end our webinar, you have to be disciplined. So you have to formulate a trade plan when you identify your buying and your entry and exit. You formulate that trade plan and you always stick to it. Even if even if the indicators is telling you that, even if market is getting exciting, you have this gut feel that the price is still gonna go up, but all the indicators are telling you that you should sell. You said to yourself, I will sell at 70 RSI. If that RSI hits 70, you sell. You stick to your trade plan. So whatever happens, you have no regrets. Although I said that, I also encourage you to tolerate your gains. If you have a position that's gaining, there's no sell signal, you're just getting really excited because you're gaining 30%, just keep it there. Keep it there, stick to your trade plan, sell only when you need to sell. So don't get too excited when you see your gains going up. But if you see your losses piling up, you really should cut your losses. As a personal practice, if, for example, I expect to gain 10% from a trade, I would set my cut loss at maybe 20 or 25% of that. So if you have a 10% potential gain, I would set my cut loss at 2% to 2.5%. So if my losses start to go below 2.5, I would sell. It's better to take your losses now than to let it balloon and get worse and worse and worse. So you can always just buy again, buy something else, or wait for a better time to buy. Okay, so I hope everything was clear. That would end my webinar. It was a bit quicker than my previous ones and less lecture-y. If you have any questions, I think we will go into the Q&A portion now, Marga.